If you've ever, looked at a company's financial statements and felt like they were handed down from some oracle, perfectly balanced but also completely opaque, then this deep dive is definitely for you.
It is.
We are going way beneath the surface today to look at the single most foundational mechanism in all of business finance: transaction analysis.
We really are pulling back the curtain on the internal engine that drives all the numbers you see. Transaction analysis is that methodical, step-by-step process that every single accountant uses
For what exactly?
to verify the immediate quantifiable impact of every business decision on the company's financial position. It's really the origin story of the balance sheet.
So our mission today is to truly unlock what our sources call the beautiful insight of the accounting equation. We want to see with absolute clarity why it must always balance.
And more importantly, what happens when it balances in complex, real-world ways.
Exactly. And to do that, we're going to use the startup phase of a fictional company, Veda Landscape Solutions, to really test these mechanics out.
And if you take just one principle away from this whole deep dive, it has to be this one core foundational rule. Assets must always equal liabilities plus equity.
A equals L plus E.
A equals L plus E. This equation isn't just a formula. It's a statement of financial truth.
Okay, let's unpack that truth then, because it sounds simple, but the implications are huge. Assets are, I think, easy enough to grasp. Those are the resources the company controls.
Right.
Cash, equipment, land, the things you have.
Correct. But the equation demands that those things you have must be matched perfectly by the claims against them. When a business gets an asset, the financing for that asset had to come from somewhere.
Ah, I see.
That source of financing is what defines the entire right side of the equation.
So liabilities and equity, they aren't just arbitrary buckets. They tell us precisely who has a claim on those assets.
Precisely. Liabilities are the claims from external parties, banks, vendors, creditors. And equity represents the claims held by the owner of the business. It's the system's way of forcing you to acknowledge, I have this resource, this asset, and here's exactly who provided the funding for it. Was it a liability or was it equity?
And that structural requirement that assets must be matched by the source of financing, that's what mandates the dual effect concept, isn't it?
Absolutely. Think of it like a financial scale that can just never, ever tilt. Every single transaction, I don't care how small or large, must affect at least two accounts to keep AL plus E intact.
Because if you only recorded one side of it,
the whole system would immediately collapse into imbalance. The discipline is, it's non-negotiable.
Wait, okay, so if every transaction has a dual effect, does that mean every single time one side of the equation goes up and the other side also has to go up?
That's a great question because that's the most common effect, but no, it's not the only one. If we introduce, say, $100 in new assets, we must introduce $100 in new claims.
So L or E?
L or E. That's one way the balance is maintained, an increase on both sides.
Okay, so what are the other two scenarios?
Well, the second way is just the reverse, a decrease on both sides. If you pay off a bank loan, your cash, an asset, decreases, and your bank loan payable, a liability, also decreases.
An A minus and an L minus.
And the scale stays perfectly level. The third scenario, this one is interesting, is where you only affect one side of the equation, but you still have to have that dual effect.
How does that work?
You can have an increase and a decrease on the same side. For example, you use cash to buy a piece of equipment. Your total assets haven't changed at all, only the composition of those assets.
That makes perfect sense. So the systematic analysis of figuring out which of those three effects applies to a business activity, that's transaction analysis in a nutshell.
That's it.
Let's see how Veda, our fictional landscaping startup, builds its financial structure using these rules.
Okay, we'll start with the foundational financing blocks.
Transaction 1. The owner of Veda invests $700,000 cash into the business in exchange for stock. This is the very first money in.
The analysis here is straightforward, but it's crucial. The company acquires a resource, cash. So, assets increase by $700,000.
Okay.
Now we have to look to the source. Where did it come from? Since the cash came from the owner, equity, specifically an account called paid-in capital, increases by $700,000.
Assets $700K equals equity $700K.
The system is balanced right from day one.
Now, Veda needs more money than just what the owner could provide. Which brings us to transaction 2. The company goes to the bank and borrows $300,000 in cash.
Right, so here, Veda acquires the same type of resource, cash. An asset, it increases by 300,000.
But the source is different.
Exactly, the source is different. It's a creditor this time, not the owner. So liabilities, specifically bank loan payable, increases by $300,000. Notice how the equation forces us to document the source of the funding, whether it's internal from equity or external from a liability.
That's pretty clear for simple financing. But, I mean, businesses rarely operate that simply, you know?
Sure.
Here's where it starts to get really interesting, when they start swapping things around, mixing financing.
And this is where understanding those three maintenance mechanisms becomes so vital. We can see the composition of assets change drastically, even if the total value stays the same.
Okay, so let's look at a straight exchange. Transaction 4. Veda buys some necessary equipment for their operations for $650,000 cash.
Right, and this is a perfect example of that third mechanism, a simultaneous increase and decrease on the asset side. Cash, which is an asset, decreases by $650,000.
In equipment.
Equipment, another asset, increases by $650,000. The net effect on total assets is zero, which means the right side of the equation, L plus E, is completely unaffected.
And this concept holds even for things that feel less tangible, right? Like prepayments. Say Veda pays $15,000 cash for future prepaid insurance.
Exactly the same logic. You are swapping a physical asset, the cash, for a financial asset, which is the right to future services. We call that prepaid insurance.
So cash down $15,000, prepaid insurance up $15,000.
The asset mix changes, but the total balance holds firm.
Okay, now let's tackle the transaction that really tests this numerical discipline. Transaction 3. Veda decides to buy a commercial property, a $450,000 complex. It's valued at $50,000 for the land and $400,000 for the building. They use $100,000 cash as a down payment and then finance the rest, $350,000, with a long-term mortgage.
This is a beautiful example because it forces us to track changes across all three components, all at the same time. The system demands that we look at the immediate cash outflow and the immediate liability creation, all while classifying the new assets correctly.
It sounds like tracking 4 different accounts at once. How does that look on the left side, the asset side of the equation?
Let's just track the assets first. Veda is giving up cash, so cash decreases by $100,000.
Okay.
But they are acquiring two separate assets. Land goes up by $50,000 and buildings go up by $400,000.
So on the asset side, we have a total inflow of $450,000 and an outflow of $100,000. That's a net asset increase of $350,000.
Precisely. Now, that net increase must be matched perfectly by the change on the right side. We just look at the source of that net $350,000 worth of assets they acquired.
The mortgage.
They financed that exact amount through a new obligation. So liabilities, specifically mortgage payable, increases by $350,000.
That is incredibly satisfying. A $350K net asset increase is perfectly offset by a $350K liability increase. The equation just forces the numbers to line up.
And we can see the same numerical discipline even when purchasing, standard goods on terms. Let's say transaction 7. Veda buys $90,000 worth of inventory. They pay $10,000 in cash immediately, but they owe the vendor the remaining $80,000. This is super common.
Let's apply the rule. Inventory, a new asset, increases by $90,000.
Right.
We lose cash, so that asset decreases by $10,000.
Which leaves us with a net asset increase of $80,000. Now, the source of that remaining $80,000 is an external creditor, which means liabilities or accounts payable must increase by $80,000.
Net A plus $80K equals L plus $80K.
The system works. It doesn't matter if the transaction is simple or complex.
We've covered assets, debt, equity, mixed payments, but there is this crucial conceptual hurdle that I think confuses a lot of people. The non-events.
Yes.
These are things that feel incredibly important to the running of the business, but result in zero accounting entry.
You're talking about executory contracts, and this is where we have to shift from what is recorded to why certain things are intentionally ignored. An executory contract is basically an exchange of promises about the future.
Where neither side has done anything yet.
Exactly. Neither party has performed yet.
So give us the examples Veda ran into. Transaction 5. Veda hires a new landscape architect. Transaction 6. Veda signs a 5-year, non-cancelable lease for a new fleet of trucks. I mean, these are huge financial commitments. Why is the accounting entry zero on the day they sign?
Because a liability is only recognized when an obligation arises from a past transaction or event. If Veda signs a lease for a truck, they haven't actually incurred an obligation yet. The obligation to pay the lease amount is contingent upon the lessor providing the use of the truck in the future.
So the promise to pay if something happens in the future is not yet a balance sheet liability.
Precisely. If Veda hires an employee, that's just a promise to pay them if they perform work. The liability to pay wages only accrues after the work has been performed. This is a fundamental gatekeeper rule in accounting. Recognition must be based on a completed past action or event that creates an unavoidable obligation.
And this leads us directly into the three formal processes, right? The ones that dictate how an item actually lands on the balance sheet.
Yes. So the first one is recognition, the formal act of recording that item. And as we saw, the executory contracts, they just fail that test right away.
Okay, one second.
Second is valuation, determining the specific dollar amount. Now, this is often the trickiest part because accounting requires us to balance two competing qualities: usefulness, which we call relevance, and verifiability, which we call reliability.
And the sources really emphasize that accountants often lean heavily on reliability. We prefer objective, verifiable data over something that might be more relevant, but is also subjective.
Correct. That's why historical cost, the actual price paid in a transaction, is so frequently used for assets like land or equipment. It might not reflect the current market value today, but it is highly reliable. It's verifiable. We have a paper trail.
And the third process is disclosure, which is what you use when you have highly relevant information that you just cannot reliably quantify.
Exactly. Take a pending lawsuit against Veda. That is highly relevant to an investor, but the ultimate dollar value is completely uncertain. We don't just put a shaky number on the balance sheet.
What do you do?
Instead, we disclose the situation qualitatively in the notes to the financial statements. The information is provided, but the system refuses to recognize an unreliable number.
So if we look at Veda now, after all those transactions, the investment, the loan, buying the warehouse, buying inventory, their financial statement would summarize to total assets of $1,430,000. And that perfectly equals total liabilities and equity of $1,430,000. It balances.
And that perfect balance tells us one more important thing about Veda's status as a startup. All of their equity, that's $700,000, it's all paid in capital. They have zero retained earnings.
Which confirms what?
It confirms that all of their funding is still entirely from debt or from owner contributions. They have not yet generated a single dollar of net income through profitable operations.
This successful balance, though, it leads us to the ultimate question for anyone trying to assess a company. If the math is perfect, what valuable information are we still intentionally excluding from the accounting equation?
And this is where we really hit the ceiling of the accounting system. The system prioritizes reliability over relevance, which means many economic events that dramatically change a company's market value, what investors actually care about, are simply not recorded.
And that's why you can see a weak correlation sometimes between reported earnings and actual stock market returns.
For sure. Investors are clearly relying on other information.
Let's list some of these excluded value-driving events our sources mention: regulatory investigations by the SEC,
Big one.
announcements of expected massive future sales, major strategic shifts, like when a company like AT&T announced years ago they were getting into the internet phone service market.
Or even global political shifts like Russia increasing its oil capacity. That affects everyone in the energy market.
But none of these major value-altering events create an accounting entry. Why?
Because they all fail the recognition criteria. There is no reliable, objective, past transaction price associated with the announcement of a new strategy or the threat of an SEC investigation. They are forward-looking, highly subjective, and just too uncertain to be reliably measured.
So the accounting system deliberately sacrifices providing investors with potentially relevant future information,
In order
maintain the integrity and the verifiability of the data it does provide.
That is the perpetual trade-off, and it's the central challenge of modern financial reporting. We demand reliability, that verifiable, objective paper trail. But the consequence is that much of a modern company's value, especially its intangible value, remains outside the formal financial statements.
It's a system built on objectivity, operating in a world driven by subjective expectation.
Well said.
This has been a really profound deep dive into the absolute bedrock of business accountability. I think the key takeaway for you has to be that the accounting equation is your structural non-negotiable.
It is.
And transaction analysis is simply the mandatory systematic approach that ensures every single resource is traced back to its specific source of funding.
And please remember the difference between a past economic event that creates a definitive liability and an executory contract, which is just a promise for the future. The system only starts recording once the event that triggers the obligation has actually happened.
Which leaves us with this final thought for you to consider. If the vast majority of value creation in the 21st century economy stems from intangible assets, things like brand recognition, specialized software, key employee talent.
All things you can't really touch.
Exactly. And those assets are intentionally missing from the balance sheet because they can't be reliably measured by a past transaction. What steps must you, as the investor or the business owner, take beyond the financial statements to accurately assess a company's true economic standing?